Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach. For our Edutrainment workshops, our entry-level introduction into life insurance, and all this week we're doing our introduction into participating whole life. If you have not seen our Monday, Tuesday, Wednesday show on this and you're looking at whole life specific, you need to go back to day one because we're really doing building block thinking here. But if you've really come in at the very beginning, you're in the last week of a 65 video vignette course. You need to go back all the way to start the beginning because there's a lot of foundational and cornerstone thinking back there that'll really help you understand what we're doing today. And remember, if you're looking at our course and you're saying, wow, what's that software you've been using all these last 3 months? We're using Lincoln Benefit Life's Eclipse illustration software. You'll want to go out to their site at www.lblsales.com/ETW. Allstate's a subsidiary of Allstate, and you'll come to this screen and you'll click on Run Installer, you'll download the software, and you'll be able to go page by page with us. It's an excellent tool. You need to do this if you're going to really walk through the tutorial with us. And again, they have great educational pieces inserted in the actual illustration system. Now, they also have, Allstate and Lincoln Benefit have an excellent marketing menu here. You can see the URL address, which is quite long, sorry to say, at the bottom of the screen. It's also inside our search engine optimization document attached to this video. Just go ahead and copy, paste, and put it in your browser. It'll put you right over here to this site, and you'll see that there's several ideas that you can take from, but I like Facts of Your Life booklet. It's an excellent tool. If you're looking for something as a prospecting tool, it's a good data collector. It harvests clients' assets and information. It can come in a hard copy book that the client can keep, or you can use attached email. Either way you want to do it, it's an excellent tool, and I highly recommend it, and it's absolutely free. They also have great prospecting letters and prospecting postcards. These prospecting tools are great marketing campaigns, especially for first contact about life insurance, especially when you don't know how to write about it. This has already been done for you, compliant, approved by Allstate, but heads up, if you're a registered rep, you have to get your own broker-dealer compliance department to sign off on this before you can ever use it, as well as if you're with an insurance agency that has similar compliance protocols, you need to make sure you get approval before you step forward. And lastly, so many people pick us up over at YouTube or Vimeo or some other person's site that they saw this posted on, and we appreciate all that. But you say, gee, Steve, I need to start at the beginning of this course. Where are all these videos? If you go out to our site, www.brokersalliance.com, and as soon as you come to our homepage, you see that big red button, On Demand Videos. All of our educational pieces are already loaded on there, and you can watch all of them right in the archives, as well as our daily internet talk show, The Business Insurance Zone, and my weekend show called Welcome to the Weekend with Steve Savant. And lastly, just remember, we're giving away our life insurance manual and our vocabulary page, which is really great. You need it because some of the language I use, say, I can't remember what Steve meant by that. Well, no problem. Just go ahead and order it. And when you do order it, just write me at thebiz@brokersalliance.com. Say, hey, I want the life manual and the vocabulary word. We'll send it to you. That's the biz, THEBIZ @brokersalliance.com, and I'll be happy to send it to you completely. It's really a good tool. Now, what I want to do now is I want to go over to a basic idea here. And when I do that, I'm going to walk you through some of the basic history of one carrier just to kind of give you an idea of what dividends do and the historicity behind it. Okay, so let's look at the example on the Mondo pad here. And we're looking at a $250,000 whole life contract, male 45, non-smoker. I'm looking at the year 1990, the year 2000, and I was going to do 2010, but I thought I'd throw in the dividend for 2012 just to make it current. What I've looked at here is I've looked at a contract where I've seen for this male 45 non-smoke, I'm looking at the guaranteed cash values, and interestingly enough, the premium being paid here is $5,910. So I'm looking at the guaranteed cash over the last 22 years, looking at the $158,485, but then I'm looking at the illustrated and actual dividend payouts over that period in time. So let's just look at that for a second. I projected right, that the illustration values after 22 years for this male was going to be $10,413. But the actual dividend paid was $15,618, a 50% difference. So that really catches my eye. The total dividends for that time, right? Oh, I'm sorry, that was cash dividends. The total dividends paid out, they projected $14,805 for this male 45, but the actual dividends that were paid were $27,000 and change. That's a huge chunk, an 82% difference. Now, the reason I want to bring this up again is I go back to I alluded to this, actually it wasn't an allusion, I guess I just said it. Index Universal Life 20-year look backs. You got to start looking at these look backs here for whole life, because if you're going to show side by side fairness and history, these numbers, some of these numbers, especially on our top 3 to 4 whole life purveyors, they're really tough numbers. Then we're looking at using the paid up additions. Now remember yesterday we said one of the dividend options that you can use is paid up additions. When we use paid up additions, the illustrated paid up additions, interestingly enough, was $329,000, but the actual paid was $468,000. The internal rate of return over that it was 32 years, not 22 years. 32 years was 5.502%. And so again, it's not going to, these are the kind of numbers that are going to be competitive when you think about comparing it to conservative investments, bond accounts, CDs, things of this nature, long-term positions. And this contract showing 5.02, and then in the death benefit, the illustration for dividends was projected at $469,000, a 5.3% after 32 years rate of return, but the actual paid out, internal rate of return was 6.64 because the paid up additions were buying more additional death benefit, as we have been talking. Now let's look at this. Here's another one. We're looking at now a female, 55 non-smoker. We're going a little older, but remember, actuarially, maybe not that much older because she may be very equivalent, close, especially today, closer to a male 45, but let's look at these numbers. She's using an $8,632 premium for $250,000 of convertible life at her 55-year-old age, non-smoking. And we look at the projections, we look at the guaranteed cash values after 32 years of $182,000, sorry. The illustrated cash dividends were at $10,068, but they actually paid $17,000. The actual total dividends were $16,732, and then the actual dividend paid $34,596. And then when you look at the total cash values, we projected it at $422 at a 2.4% rate of return over that period in time, and against a 4.96 rate of return, which was our actual return. Again, we're looking at numbers that we're trying to show a projection. We're trying to show basic math and see where these numbers lay out and where we're coming to as far as, is this a good deal, is this a bad deal? So when I'm looking at this, I'm looking at basic patterns, and now let's look up here to our male 35. Again, I'm paying male 35 non-smoker $4,427. I'm looking at the projections again of guaranteed cash values and guaranteed dividends. I'm always looking at the internal rate of return, and if you really want to start moving into the fiduciary market where you're showing the value of these kind of contracts to CPAs, enrolled agents of the IRS, tax attorneys, and some trust officers who actually have oversight over these contracts inside their trusts, you're going to have to get into using internal rate of return on cash values and on death benefit. Really, it is the way, it's the barometer, it's the way the fiduciaries look at it. The internal rate of return is everything. You also need to do, if it allows, it's a little different in whole life, you need to print the expense pages off so you can show everybody what you're doing. Now what I want to do is I want to go to this next page, but I think you're going to find really illuminating, it sure was for me. Now on the Mondo pad, I'm looking at a carrier that actually is representing some of the past history. There are actually two carriers involved, so they split these two actual grids or charts based on the two carriers. But what I did was I also looked at the composite carrier to try to see what kind of numbers I really had here. And when you look at this, it's fairly interesting because I'm looking at the dividend history back in 1978, just trying to get a basic idea of what was going on back in the day. So I'm looking at this single carrier now, which is the composite of these two carriers. And I'm looking at the 1978, the interest rate. Remember where interest rates were. I mean, look at some of these double digits that were going on back in the day. We're sitting in 78 at 7.40. But look, in the year that I came into our business, a big banner year for the insurance carriers, I'm sure. In 1983, we went from 9.22 and we hit double-digit rates of return in dividend interest rate. So when we look at 1983, we're at 11.6, and that is a monster number. I mean, what a bump up. There was a small gradual, and then we went right up into double digits in 83 and stayed there until we topped out in this specific example. And remember, there's carriers that actually exceeded the number I'm going to quote here. That was, here it's 12.2 interest rate dividend credited to these contracts, but there were actually a couple in there at 13%. They had huge bond portfolios that whoever was their portfolio manager did an excellent job. But look at these numbers, they're huge. But then somewhere around in the 90s, we saw it starting to decay. So interest credited went down, now we're at 10.5, and then in 1992, many carriers slipped under the double-digit rate of return for their dividend interest, and it started to decline. And you can see from 93 and starting to go down, 9.45, 9.3, 9%, 8.4, 8.4, and it held. They tried to hold it all the way through just before we got into the year 2000. Then we have the dot-com bubble, which I don't really think affected this too much, but it stayed pretty level again at 8.3, and then all of a sudden in 2003, it dipped below the market, and all of a sudden we start going below 8, and we're in the 7s, 7.5, 7. Now we're going by major chunks. Interesting to note that in 2007, we were sitting at about 7.55. This carrier actually went up in 2008 during the crash and all the economic troubles. Then it started to go back down again, and in 2010 and 2011, we were sitting at 6.85, and in 2011, 6.8. But last year, we went back up over 7. So there was a little bit of recovery. But when you look at the historicity of this, it's pretty interesting because you can understand why did premiums not vanish? Well, look at the interest rates and the crediting that was going on at the time. Remember on Monday, we talked about, this is the bulk, or it was Tuesday show, we talked about the bulk of the dividend is a composite of their interest credited from their bonds. So when I'm looking at this, they were getting tremendous returns from their bond accounts. When that started to change and the government started issuing investment grade government debentures, those numbers started to come down as the government tried to force down interest rates. And of course, we're living in the lowest interest rate in my lifetime, and maybe perhaps in the last maybe 50 to 60 years. So when I'm looking at this kind of idea, it shows me basic historicity and gives me the big picture. And if you're into that 20-year look-back comparison, that gives you a little idea. Now I want to go to a next chart here, and I think you'll find it as illuminating as this one. Now this graph shows, again, another carrier comparing their dividend history to treasury rates. And if you look at this, this is huge. I mean, when you think about how big this really is, this is a pretty big deal. So when I'm looking at this graph, I'm looking at from years 2003 to 2012. So I'm looking at basically a nice 10-year period to kind of see what's been going on. Now, the dividends for this carrier, for the whole life carrier, is actually in green. And you can see the rates here, 10%, 9, 8, 7, 6, 5. And then you see the treasuries 10-year in blue, and you can see it declining. And I would say that's an understatement because the treasuries are now under that number. They haven't really showed a new reflection for this year. And then you're looking at one-year treasury rates, which are in yellow. And remember, when I came into the business, I was always taught that long-term rates always outperform short-term rates. And now we see that happening, but wow, there's some crossover time, and we saw that in the 90s, and then we started to see different rates of return really compounding the pressure on carriers to come up with a good rate of return. So when I'm looking at this, I'm looking at the dividend rate all the way out. So every year, this whole life purveyor beat the 10-year treasury, the 1-year treasury, and the 1-year treasury rate, 1-year average I should say, and 1-year treasury rate. So in the last 10 years, I'm looking at all this dividend. If I'm a long haul thinker, if I believe that this is an alternative for conservative investing or savings, and I'm looking to compare it to government issue, 10-year, 1-year averages, or 1-year treasury, the actual rate, you can see in the last 10 years, this carrier has done an outstanding job, and always in the top 5 to 7 carriers always seem to be above the line, and that's why I like this as a long-term investment play for conservatives.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.